Welcome to the 2023 Forager Roadshow. We are very excited to have you here today, as it has been a good year for both of our funds, and we are looking forward to taking you through some of the details. I'm Alex Larkman, the business manager at Forager, and I'm here to tell you how today is going to work. Everything you hear today is general advice only and has not taken your personal circumstances into account. If you are considering making an investment, you should speak to a financial advisor. Firstly, Steve Johnson, our Chief Investment Officer, will give a quick introduction to the Roadshow with a high-level summary of what has happened during the past year. He will then hand over to the International and Australian Shares Fund teams, who will present on their respective funds, including performance during the past 12 months and how the portfolios are currently positioned. The fund presentations will take around 20 minutes each. After this, we will come back to the studio here, where Steve will host both fund teams in a Q&A session. Please type any questions you have into the Q&A box at the bottom of your screens. You can add questions at any point during the presentation. Now, let's get started with today's Roadshow.
Hi and welcome. I'm Steve Johnson, Chief Investment Officer here at Forager Funds, and it's a pleasure to be here in 2023 after having had a much better year than we had in 2022. We've got lots of good things to talk about today, some interesting businesses and a good year of stock performance as well. You can see up on the screen now the performance for both funds for the 2023 financial year. We returned 19% for the International Fund and 17% for the Australian Shares Fund. For the International Fund, that was a touch less than the index. For the Australian Fund, it was a decent amount better than the index for the year. For both of our funds here at Forager, we have a heavy skew towards small cap stocks in them, and it was another year where small cap stocks fairly dramatically underperformed their larger counterparts. So we're happy with the performance, and as I said, there's been some good stuff going on underneath the surface. I've talked about the parallels between my farming upbringing and the share market a lot over the past 20 years. And I have never quite seen the droughts and flooding rains of the stock market be like they have been over the past 5 years. That's been true of the wider market, and it's been particularly true of our fund's returns. This is a chart for the International Shares Fund, and you can see that giant 2021 year, followed by a reversal of a lot of that in 2022. The magnitude of those returns has really put the scale out of whack on the left-hand side. There were big years of outperformance and underperformance prior to that as well, but what happened in 21 and 22 was significant. This 2023 financial year has been a return to something a bit more normal, and it's really important that we build on that and put a few years of good returns together. We're going to talk about how that's going to happen in today's presentation. Look, the backdrop for those returns has been an extended period of underperformance of small cap stocks. This chart is going back 5 years, and you can see that small cap stocks have underperformed their larger counterparts by a very significant margin, and that did not reverse in 2023. It was a year where the outperformance of large caps was not as significant as it had been, but there was certainly no catch up in terms of performance. That put our 19% year into context, and we're very happy with the returns that we've achieved there, as the team will talk about later. Lots of takeovers in the portfolio and some idiosyncratic stock outcomes driving returns. This is our return by financial year for the Australian Shares Fund. I really wanted to highlight that 2019 year here. We have talked a lot over the past few years about that year and changes that we needed to make to our process and philosophy to ensure that that didn't happen again. Things have been really buffeted by external market conditions over the past few years, and you can see that the volatility has been extreme. But we are actually very positive about the changes that we made back in 2019, and we're seeing those flow through to portfolio returns over time. And the 2023 year was a really good year on that front. A 17% return in a year where small caps dramatically underperform large caps. Again, it has been even more significant here in Australia than it has been globally. In fact, if you look at this chart going back 5 years, the small cap index here in Australia is hardly up over that 5-year period, where you've got the large cap index up almost 50% over the same period. So there's been dramatic underperformance and we've had a pretty good year, and that leaves us in a really good place to be able to keep recycling capital into new opportunities and into a market that is still offering significant amounts of value at the small cap end of the market. Look, across the world, this rally that we've seen so far in 2023 has been mostly driven by a very small number of large cap stocks. It has broadened somewhat over the past month and carried more of the market with it, but we are still in a very bipolar market where a small number of, I think, expensive, very large stocks are driving all of the market returns, and it's leaving large parts of the market by stock number with substantial amounts of value available in them, and you're going to hear a lot about that in today's presentation. So let's kick off with the Forager International Shares Fund, and we've got the two portfolio managers of that fund, Harvey McGoddy and Gareth Brown, here to talk you through what's happened and what's going to happen throughout 2024.
Hi everyone, thanks Steve. This is our international fund team. Steve Johnson, our CIO, he doesn't need a lot of an introduction, but for the purposes of this particular fund, his main job is to provide the guide rails that the rest of the team operate within. He has a natural affinity for special situations and industrial stocks, and he's also a very valued sounding board for the rest of the team. Harvey McGoddy and I are the portfolio managers of the Forager International Shares Fund, which means we're responsible for the makeup of the portfolio within those guide rails that Steve sets. Although the four of us on picture here very much operate as a team, we discuss ideas and often argue quite vociferously our viewpoints. Harvey joined us in 2019 and brought a focus on technology, industrial and consumer stocks. Harvey has a real eye for underappreciated growth. He's mostly focused on the North American market, but he's also responsible for some of our investments outside the region. I've been working on the International Fund since inception in 2013, and like Harvey was given the role of portfolio manager in 2020, I gravitate towards long-term buy and hold investments. My area of focus is typically in infrastructure stocks, gambling, and the quirkier side of the consumer and industrial spaces. I like some of the parts plays as well. I'm typically focused on UK and Europe, but again, look elsewhere in the world as well. Chloe Stokes is a senior analyst with the fund and has been working for us for more than 5 years now. She's built a really strong repertoire around retail and consumer-facing stocks. She's also been a very good analytical resource for the rest of the team. And lastly, I'll mention Bella Foley, who's been working for the company for a few years now and only recently crossed over to working on our international fund. She's done a lot of great work over the past 6 or 9 months on some new ideas and is also bringing more analytical firepower to let the team cover more and more of the globe. This is a brief introduction to our International Shares Fund. I think most importantly, we run a highly concentrated portfolio, around 20 to 40 securities around the world. It's our portfolio of best ideas. We are mainly focused on larger developed markets like the US, UK, continental Europe, and Japan. Crucially, we have a flexible mandate. It allows us to invest wherever we see the best risk-adjusted returns. Small caps are likely to always be an important part of the portfolio mix for us. We are intentionally capacity constrained. We want to retain the ability to put money to work in our very best ideas, which is very often in the small cap space. Size is a constraint to performance in smaller cap stocks, and we will not allow this fund to get too big. Lastly, we have a small team. It's often asked, how do we cover the whole world? Look, we're intensely focused on those areas of deep expertise that we have individually, and then we come together with a common goal of harvesting inefficiencies where we find them, whether that's through a behavioral edge or an analytical insight, or ideally both. One thing we can promise is this fund will never look like an index fund. Here's the fund's returns over the important 1, 3, and 5 year periods and since inception. As you can see, the fund has generated decent absolute returns over those periods. We have lagged our benchmark index. That's at least partly a function of the period we find ourselves in today. Smaller cap stocks, which is a mainstay of our portfolio and is not an important part of the index which we follow, have had a very difficult few years. The index we compare to has that far lower exposure. We're going to talk more about that offer in small caps, the value on offer in small caps at the moment, but we absolutely want that exposure most of the time and particularly at the moment. In our June quarterly report, we likened the current situation in small caps to a coiled spring, ready to bounce at the first sign that bad news abates. Owning lots of small cap businesses isn't a bet that paid off in a relative sense in 2023. It was a continued mild headwind. We've almost kept up with the index regardless, so we're very happy about that situation. We think our concentration into smaller cap investments will pay off handsomely sometime over the next 3 to 5 years.
Thank you, Gareth. And here is our portfolio contribution for the year. It's been a broadly regular year in terms of stock contribution with more winners than losers. This is what you can generally expect from Forager. We took profit in some of the names that have outperformed and added to some of the losers that you can see on this chart. We'll touch upon a few of them later. Now, generally, throughout this list, you can see that there's a number of idiosyncratic names in there, i.e. we're not overly exposed to one single theme or any type of market caps. We have a broad mix of large caps, mid caps, small caps across various sectors. So we're pretty happy with this performance and the fact that our returns have come from a variety of sources and not just at one specific bet in the market.
Let's start off our review of the highlights and lowlights of 2023 with a few lowlights. It's always important to get the bad news out of the way first. Motorpoint is a used car retailer in the UK. We underestimated the magnitude and duration of inventory shortages in that near new car space that Motorpoint focuses on. These shortages were direct knock-on effects from shortages in the new car industry from 2020 to 22 related to COVID and to a shortage of computer chips. We underestimated how significant those knock-on effects would be. Car retailing is very much a volume game, and because of this, Motorpoint's profit this year that's just been completed and in the current year is sort of being eroded away. It is not loss-making, but it will not be making a significant profit. The stock is down dramatically as a result. To put it into valuation perspective, the stock is trading now at less than 5 times the profit that this business made in 2019. Now, this is a business that has increased capacity and has potential to earn significantly more money in a more normal environment than it did in 2019. And importantly, this is a business that can distribute a significant share of its profits directly to shareholders. There are risks here. The economy over there is tough, but this is the sort of coiled spring that we are seeing in smaller cap stocks elsewhere.
Another loser for us this year was TaskUs, an IT outsourcing company. It's had a tough couple of months as the market is very concerned about some of their core customers, which happen to be high growth tech companies such as Meta and Uber, lowering spend. Now, the recent results actually showed a really stable margin profile, and the company just announced a 200 million buyback. This is a significant portion of its overall market capitalization, which signals confidence in the business model itself. The stock is trading on only 8 to 9 times earnings, which is really cheap when you compare it to other IT companies out there and other outsourcing companies. So we actually added to the position over the past few months, and we feel there's solid upside over the next few years.
Now let's move on to the highlights. It's always the more fun part for us to present. We presented our thesis for Flutter last year at this event. The background is in the US, sports betting was illegal based on a federal law prior to 2018. Subsequent to that, states have been able to make up their own minds about whether to legalize. So the market has exploded from nothing 5 years ago to being very large versus other markets around the world, but it is still very much nascent and has at least another decade of fast growth ahead of it. It's been our belief, based on years of experience here in Australia and also in Europe, that sports betting is a winner-take-most business. That was a core part of our thesis. And all the state-level data that we'd been tracking last year suggested that Flutter's FanDuel operation was going to be that winner in the US. US stock markets, however, fairly new to the whole sports betting scene, hadn't really grasped that point yet. And to the extent that they were even looking at the sector, it was focused on US-listed players, not Flutter that was listed in Ireland and the UK. Look, that thesis has played out very well for us over the last year. The stock has approximately doubled. The rest of the market really is starting to pay attention to those points that we highlighted last year. We've sold a lot of our shares over the last few months in particular, but it still remains a top 5 position for us, an important position, and we think there's at least a decade of rapid growth ahead still. Norbit, I think, is a really good example of the kind of bounce you get from one of these coiled springs that you get in small caps. It's a Norwegian business, a high-tech manufacturer with 2 main focus areas. It is big in the sonar business, which has obviously got marine uses, and also connectivity systems for vehicles. So from the toll tags you might even have in your own car to pay for your motorway usage, right through to smart tachograph systems that are mandated in Europe to monitor drive times and performance of drivers of trucks and buses. We've owned the stock since the 2019 IPO, and over the past 4 years, it's made really strong continual progress on the business, which was coiling the spring, but the stock market largely ignored the story until this year. Stock has promptly doubled over the past year. We've trimmed the position quite aggressively, but it still remains an important position for us.
Well, Meta certainly needs no introduction. It's one of the biggest businesses in the world, and I'm sure that everyone has an opinion about it. It was actually one of our largest contributors over the past year. It inflected back in November, December. We added to the investment around a similar point in time when the stock breached $100 per share. It's currently at $300, so it's been a tremendous rally from the company. So why have we seen this rally? I mean, there's been excitement surrounding their AI investments, that's for sure. They're increasing time spent on Instagram and on Reels. The company has come out with positive data points around that, and we all know that everyone's very excited about anything AI these days. But more importantly, the series of cost cuts announced by Zuckerberg after pressure from investors last year has really helped improve the trajectory and the outlook for the earnings for this company. That, combined with inflection in revenues that we were starting to see, has actually resulted in a decent amount of earnings upgrades and the share price getting back to a more regular multiple. Recently, the company just launched a competitor to Twitter called Meta Threads, and within 1 week, they've reached 100 million subscribers. Whether or not they actually stay there and continue to use it remains to be seen. But I think it just does show the potential of what's underlying in the business. There's a lot of things that they're doing internally that I think the broader market doesn't necessarily look at when they look at near-term factors. And the thing we like about this example is that it really shows how pessimistic sentiment around a stock can get. Even one of the biggest companies in the world, I mean, this is a mega cap, and drive valuations to almost ridiculous levels for a business that is going to be around for a long time. So that's been a positive one for us this year. Another company that we've spoken about a number of times in the past is Zeta Global. It's a company we continue to hold, where we manage to boost returns through active portfolio management. This company has had 8 sequential quarters of profit upgrades in a row, and yet throughout last year, the market really decided to punish it. It was down more than 50% at one point. We actually doubled down on our position back then and have done really well off of that since. Now, we've taken some profits off the table here. It's nice to always put some in the bank, but it remains a decent sized position for us, and we continue to see upside in the long-term story here.
When you believe you own a portfolio of underpriced securities, it's very nice confirmation to be regularly receiving takeover offers from acquirers. And we've received 3 such offers during 22-23. Twitter was certainly one of the weirdest takeovers that we've ever been a part of. It was a very welcome get out of jail free card on an investment that we really had no right to make a profit on. We did make a profit, so thanks very much to Elon there. We've held a position in a small LNG carrier business called Gaslog Partners that we bought at an absurdly cheap price. We received the takeover offer this year that was still way too cheap, but a very nice outcome for the fund on a small investment. And lastly, there was the partial bid for Flughafen Wien, which is the owner of Vienna Airport, by the Australian funds management group IFM Investors. This bid really got up our goat. It was holding a liquidity gun to the head of small shareholders and minority shareholders. We talked extensively with other minority shareholders about this one. We aggressively lobbied the board and management, and we also took our complaints to the Austrian Takeovers Commission. Now, I have no idea whether we moved the dial on this particular issue, but ultimately IFM was hamstrung in their ability to take over the minority shareholders of Flughafen Wien. We're very thankful for that. The stock price is up more than 40% from IFM's offer price.
Yeah, and this is a sector that we spoke about towards the end of last calendar year, around December, on various podcasts, but the US housing and construction space. It's been a great performer this year, and we did increase our own exposure to it at the end of last year. Valuations got to almost ridiculous levels. You had some home builders trading on single-digit PEs, that's price to earning multiples, and one of our long-term favorites, Installed Building Products, was around 7 or 8 times earnings. Now, as soon as new home sales in the US started stabilizing towards the back end of last year, all of a sudden the market started getting excited about all of these companies once again, and we've had a decent amount of rally in a bunch of the names, as you can see on the chart on the page. Now, having said that, they still are trading below historical norms, and we continue to hold both investments here, for both Ferguson and IBP. Now, we feel that Ferguson's exposure to non-residential construction in the US and the fact that more than half their business exposed to repair and remodeling means that it's going to be more resilient, even if the larger downturn hits in the United States. So it's one of our biggest positions. We continue to like it. We think there's tremendous potential here over the long term.
Here's an insight into our top 10 holdings as at the end of the financial year. On the left-hand side, you can see what that current top 10 is. It's a range of idiosyncratic investments across different market cap ranges and across different geographies and industries. Beyond these, we have a number of quite exciting ideas that just don't quite make it into the top 10. There are things that we might talk about in a coming quarterly report. On the right-hand side of the chart, you can see there the distribution by market cap size. Just important to note, 2/3 of the fund currently invested in businesses less than 10 billion and more than 1/3 in businesses less than $2 billion market cap. So higher exposure to small caps. That's fairly normal, but it is something to be aware of as an investor. We'll touch on a reason for our exposure to those smaller caps again further on in this presentation.
So what are some of our best prospects for 2024? Well, 40% of our portfolio is invested in underpriced small cap bucket, or as we refer to it. Companies such as Cryoport, Taskas, Janus, Destination XL, and Open Lending all belong in here. There are no single individual huge bets. We have found a broad range of value across various end markets and across various companies. Now, part of the reason for this is that the last years have just been terrible for small caps in general. They've derated a huge amount. We'll touch upon it in a couple of slides. Another bucket worth pointing out is the quality compounder one. Now, you may be familiar with a few of the names here. We've discussed them in detail in the past, Zebra, Keysight Technologies, but it will always be an important part of a portfolio. Quality compounders trading at reasonable valuations. You can always find some of them in across the market because the market always gets pessimistic at certain points in time. And what I would mention here is that we used the market meltdown back in last October, November to add to some of the core holdings here.
We've already talked about how US housing-related investments paid off for us last year, and Harvey's actually going to outline the case for 2 of those investments, Ferguson and Fortune Brands, in a moment. But just for completeness here, we thought we would point out it is still an important bet for the fund. It makes up about 13% of the NAV at the moment. Lastly, we remain long the UK. They're all extra whingy over there at the moment, and not just the cricket fans. It is a difficult economic environment in the UK, but it is also a land of cheap stock prices. At one extreme, we own something like a Motorpoint, where if the world normalizes, it has the potential to rise several 100% from here. At the other end of the spectrum, we own the market-leading supermarket brand Tesco at 11 times earnings. That's provided resilience for us over the last few years, and it's a business that will be impervious to all but the worst economic downturns. And also on that same side, we own Blanco, which is a truly global business that generates some 90% of its revenues outside the UK.
So Ferguson and Fortune Brands, what do we like about these two businesses? Well, they have some similar characteristics. One is that they're M&A roll-up stories. That means that they go around buying smaller mom and pop type businesses in fragmented markets at attractive valuations. They extract top line and cost synergies and help grow through that method. But they also grow very well organically. They're market share leaders in their core categories and have over the past 10 to 20 years consistently taken market share. On the right-hand side of this page, you can actually see the past 10 decades for both companies and their sales growth. It's been quite extraordinary, 10% CAGR for these kind of businesses that are somewhat cyclical, but nowhere near as cyclical as the market sometimes tends to price them. And we think that over the past 12 months, we've seen this mispricing by the market, which is why we've invested in both of these opportunities. Now, there are idiosyncratic explanations for the attractive valuation that we've been offered and we've been able to buy them at. And we also see some resolutions on the horizon. So Fortune Brands, which is a manufacturer of products such as high-quality faucets, shower heads, and home security systems, they spun out one of their divisions 6 months ago or so, which was their cabinets business. This is a business that has been underperforming for the better part of the last decade and has been masking the quality of the underlying rest of the portfolio. So they've essentially created a good co and a bad co. And moving on to Ferguson, well, Ferguson is a business with 95% of their revenues coming out of the US, and yet it used to be listed in the UK. They did have some other divisions which they've spun out over the past few years, but they're almost a US-focused pure play at the moment. So, having listed to the US, we see a number of catalysts on the horizon. S&P 500 inclusion is one of them. They certainly qualify. That could be happening any point over the next 6 to 12 months, but also other indices. There'll be some forced buying there, but it also forces people that cover this sector to look at this beautiful company that we think has done a tremendous job over the many, many years with a very high quality management team.
Janus is the market leader in automatic door and access systems used in the increasingly unmanned self-storage industry. It has really a strong long-term profit history, a very good order book, and it generates great margins and cash flows, and has been a very overlooked smaller business. The self-storage industry can have some pretty brutal cycles, so we're careful about our overall exposure to the industry and to this business, but it isn't totally reliant on the new build of self-storage systems. There is a massive retrofit going on around the world in these self-storage sites where they really need to provide high security, keyless entry systems for their users, and that's really underpinning the order book for this business. Lastly, we've owned Blanco for 6 years now and we've done very well out of it. It's a stock that some of you will be familiar with, but it remains an important investment for the fund and is worth touching on here. Blanco is a globally dominant business in a tiny niche called data erasure software. It's a perfectly effective way of wiping the contents of a hard drive at the end of the useful life of a piece of IT hardware equipment. And it's far greener than one of the main alternatives, which is to physically destroy that hard drive. You are now free to reuse, sell, or recycle your equipment. And Blanco offers a genuinely better solution than a lot of the solutions out there. Business is highly recurring in nature. The same customers come back time and again to order more licenses. This business has grown by acquiring new customers, but it has also grown by deepening its relationship with existing customers. Many of the world's largest tech customers use Blanco, but they might use it in one geography or in one segment of the business. The Financial Times in particular has had some interesting exposés over the last 12 months criticizing the practices of large IT firms around the world who are still using an awful lot of physical destruction when they get through their mountains of IT equipment each year. In a world where both data security and environmental and ESG credentials are becoming increasingly important, that's got to change. That is changing. And by doing so, these businesses are likely to do more and more volume with Blanco each year. Lastly, we've long thought that Blanco had some significant untapped pricing power. Most software as a service businesses are now putting up prices annually with very little friction from customers. Blanco is a business that could do that, we feel. It historically hasn't. Pretty much all of its revenue growth has come from volume growth. That's changing. And even if they're able to push through a 5% annual price increase, it's going to meaningfully boost the growth rates and the margin profile of this business. I think this is a really good example of the kind of opportunities that small cap pessimism has been creating over the past year or two. Over the 2 years to 30 June, Blanco will have grown its revenue cumulatively by 30%. Over the same time frame, its stock price is down 40%. The last few results have really started to prove how profitable this business can be over time. As is usual, it only takes one bit of good news to get the dial moving. In this case, it was recent confirmation of a reasonably strong second half result, and the stock has risen about 20% in the less than 2 weeks since the start of the financial year. Due to that growth, Blanco has become once again the largest position in the fund.
So we want to leave you with two really key important slides about what the setup here actually is. We mentioned that 2/3 of our portfolio is exposed to companies with less than 10 billion market cap in size. Well, why do we like the setup for these kind of companies at this point in time? They have a history of long-term outperformance versus the broader market. On this chart here, you can see the Russell and the S&P small cap index versus the S&P 500, i.e. the large caps, over a period of 23 years or so. Long history of outperformance. They tend to grow faster, they're smaller businesses, and their more mature counterparts. Often growth slows as you enter that phase. So other more important part here is that they tend to do very well from early on in recessionary periods. We've looked at the last kind of 5 recessions and there's studies on this, but they actually start to bounce as you enter into a recession. Now, the current market exposure, this is in the US in particular, to small caps is extremely small. We're talking about 5% of the market cap being small caps at the moment, which is right near the COVID-19 lows. That presents a really exciting opportunity. M&A is another important tailwind for these kind of businesses. They're obviously smaller, so larger companies tend to gobble them up if there's value to be had there and if they're trading at too cheap levels. But doing M&A as a smaller company also tends to move the dial more than for your average mega cap or large cap. Now, these companies are generally under-researched and undercovered by brokers and other investors to some extent. You have an average of 3 brokers covering a company of this size relative to 15 covering larger caps. This actually allows you to do your own research, do a lot of work around the company, valuation, expert calls and so forth, and try to find undiscovered hidden gems within that pool. We've been pretty successful in doing that over the last few years, and we think we found some really good ones here that we're investing in at the moment, including some new names that we'll discuss over the coming few months. Now, this final chart here actually illustrates how severe this discount has become, particularly over the last 2 years. Small caps tended to trade at a premium, or at least in line with the S&P 500 over the past, 20 years. But what's happened more recently, since 2021, is a humongous relative derating. They're now sitting at a 25% discount, as you can see on the chart on this page. Now, the past year has shown us some signs of stabilization. We actually firmly believe that the worst is largely behind us in terms of this derating. But there's a lot of pent-up upside in many of these companies and many of these valuations at the moment relative to the broader market. And this is why 2/3 of our portfolio is currently invested in companies less than 10 billion in size. So we hope it's going to be a good couple of years ahead of us. We feel confident that we're in some very strong and quality businesses as well. So thank you all very much for joining us, and over to you, Steve.
Thanks, Harvey and Gareth. That's a great summary of last year's performance returns and what your expectations are for 2024. We'll move on now to the Australian Shares Fund. A quick reminder of what this fund is about. It's exactly the same philosophy that we employ across the business. We are trying to buy companies at prices that are going to give us long-term returns in excess of the returns from the market. A couple of key differences about this fund though: it is listed on the ASX and trades under the ticker FOR, so you buy and sell units in the fund on market rather than applications and redemptions like we have with our international fund. It is a smaller universe of stocks, so there are typically less investments in this portfolio than in the international fund. That's currently 30 at the moment versus about 40. And this fund has a stated distribution policy to target a 4% yield per annum. So last year we made distributions totaling 6 cents, which equated to almost exactly that 4% return, and we will aim to do that in future as well. Otherwise though, it's the same philosophy, and you'll notice a lot of the same themes as we go through today's presentation. I touched on this right at the top, but it has been a good year for performance. We outperformed the market by almost 3% in 2023, and you can see there that that 3-year number is starting to look a lot better. And as I said right up front today, that 2019 financial year, it's now 4 years in the rearview mirror. And as it rolls out of that 5-year return over the next 12 months, you can expect to see our 5-year returns looking a lot better relative to index as well. Down the bottom of this slide, you can see the small ordinaries index over the relevant periods of return as well, and the small industrials index. And you can see that small cap stocks have performed dramatically worse than their larger counterparts, because that market cap weighted all ordinaries index is mostly large cap stocks. It's been a really difficult period, and for a lot of the same reasons that we've explained in the international fund, we do expect that to reverse at some point over the next 3 to 5 years. I'm the portfolio manager of this fund, so I make the decisions about what the right portfolio weightings are and how we're going to allocate our portfolio here. But the two guys doing all of the work in terms of stock selection and stock research are Alex Shevelev and Gaston Amoros, the two senior analysts on this fund. And they're going to take you through what's happened over the past 12 months and how the portfolio is positioned today. So here's Alex to talk about contributions in 2023.
Thanks, Steve. So the major positive contributors dominated the year 2023. We had one poor performer that cost the fund more than 1% of performance, and 10 that contributed more than 1%. Now, some key investments, they delivered meaningful performance boosts. Gentrack and THL, two of those. A handful of takeovers helped the year, alongside some investments in larger stocks that helped bolster the performance. Let's go to one of those now. The combined THL and Apollo business is now listed on the ASX and NZX. It is a manufacturer of recreational vehicles, rents those recreational vehicles out, and subsequently sells them. And the business operates in Australia, New Zealand, North America, and in Europe. Now, the Apollo merger finally took place during the year. It finished in December of 2022. The synergies off of that merger are significant. They are larger than the pre-COVID earnings of Apollo. And we saw during this year that the tourists have come back to Australia specifically. We saw the start of the year having a nearly 60% fewer international visits to Australia, finished the year at nearly 20% below 2019 levels, so continuing to improve. That really helped the combined business. In the last half, earnings before interest and tax rose to about $84 million from break even the prior half. Rental prices as well, we think that's a big, meaningful positive for the business heading into 2025. They're due to stay higher than pre-COVID for a host of reasons. The business contributed 6.2% to the portfolio's performance during the year. Gentrack is a technology business that contributed more than 5% to performance for the year. It is really a turnaround that had turned around during the 2023 financial year. The last reported half of profitability saw revenue up 48%, as work on a UK energy customer that the market thought would decline actually increased quite dramatically. The business went from losing $6 million to making $8 million relative to the prior corresponding period. And during the 12 months to March 2023, the business generated $25 million worth of free cash and finished with $42 million of cash and no debt. Now, this UK customer will decline in terms of its revenue for next year, but the business has done a great job in selling more to its existing customers and bringing new customers on, such that profits are actually due to grow next year. Now on to the merger and acquisition activity impact on the fund in 2023. We've included Apollo here for completeness, alongside 3 other deals that contributed meaningfully to the portfolio performance, in total 6.8%. Now, MSL and Nitro, they were both sold to private equity buyers. Nitro especially was a well-contested process by 2 quite aggressive bidders. iSelect was finally sold in a long-mooted process, with its largest shareholder and largest competitor being the eventual buyer. You can see the premiums are quite significant amongst this group. This is a sign of just how depressed valuations had gotten for these sort of businesses. And it's worth pointing out unsuccessful bids as well. We had 2 in the portfolio, which potentially suggests more activity in 2023.
Thank you, Shiv. And moving on to large caps, a couple of positions worth calling out, Qantas and Seven Group. It doesn't happen often that you see companies of this size posting nearly 50% gains in 1 year, but we feel pretty happy about it. Talking about Qantas, they had a pretty strong year of recovery out of the pandemic, with the shares closing up nearly 40%, and in what was a record year of profits and cash flow for the airline. If you think about the underlying drivers of the business, so if you remember your last experience booking tickets on Qantas, you can probably relate to pent-up travel demand, limited supply of seats or new planes, and limited competition. And if you think that this is as good as it gets for an airline, we wouldn't disagree with you, and as a result, we exited the year with a fraction of the initial position. The other one, Seven Group, is another large cap stock that proved the cynics wrong throughout the year, closing nearly up 50%, with its 2 key drivers, Caterpillar dealer Westrac and equipment rental company Coates, firing on all cylinders. And now moving on to small cap software. This is the land of volatility. We have Fineos on one end of the spectrum that had a very good year both for the stock and for the business. And this is volatility, by the way, that we took advantage of, as you can see on the chart on the right. We give credit to the management team for growing recurring revenue quite strongly, landing new marquee customers like Guardian Life, and also putting the business on a solid cash flow footing. On the other side of the spectrum, we have Whisper, which was the single biggest detractor to the portfolio in FY23, and that's on the back of a very strong 2022, where they grew revenues by almost 50%. But it turned out that a lot of that revenue wasn't as sticky as they thought and we thought, and as a result of that, they entered the year with the wrong cost base. They were slow to cut costs, and as a result of that, they nearly ran out of cash by the end of the year, and they had to resort to some expensive debt financing. Now, having said all that, there is a core revenue base here which isn't going away. There have been plenty of transactions in the sector and multiples way higher than where Whisper is trading today. So we still have a position of less than 2% in it. So looking forward to this current fiscal year, we have an interesting collection of idiosyncratic and defensive positions throughout the portfolio. Just to name a few, around 1/3 of the portfolio is exposed to technology or tech-enabled businesses that should be more isolated from the woes in the economy and exhibit some secular growth characteristics, and Alex will talk about ReadyTech later on.
We've also got a selection of beaten down micro caps. These are smaller businesses. They've been sold off recently to very attractive levels. An example of this is Jim's Group, Viva Leisure.
We also have, as you can see on the slide, we have 10% of the portfolio which is exposed to healthcare demand, which tends to be very uncorrelated with the economy. And in this case, in particular, it's rebounding from a couple of years of suppressed healthcare consumption due to the pandemic. And in particular, we'll talk about integral diagnostics later on.
And tourism remains a reasonably large investment in the portfolio. Both Tourism Holdings and Experience Co, both these businesses will be going into 2025 before they reach their more normal profit expectations. Relative to a few years ago, the portfolio has a smaller number of higher conviction ideas. And fortunately, these are higher quality and importantly growing businesses that remain at very attractive valuations.
And you will have seen us over the last couple of years balancing the portfolio of small caps with some larger, more resilient and liquid businesses, the likes of Qantas and Seven Group that we talked about before. The reason why you see in this slide cash at 20% is, and by the way, so as of this moment, cash is substantially less than 20%. But the reason why you see that number is that we're not finding enough good risk rewards on large caps. It was relatively easy 1 year ago when Qantas was trading at around $4, so when Seven Group was in the teens, but most of those opportunities are gone by now. It's also important to emphasize that the required return for large caps and small caps within our portfolio is different because the risk profile associated with these businesses is also different.
Now on to one of the key investments for 2024, and that's mining software business RPM Global. The business has done a great job of growing recurring sticky revenue over the last couple of years, and especially in 2023, what we saw for the first time was that incremental revenue translating into incremental profit, an almost tripling of profit in 2023 to be precise. Now the business has about $35 million worth of net cash and has been using that in a buyback of late. Now that operating leverage, it's actually due to continue into 2024 as again, higher levels of revenue and a controlled cost base mean higher profit growth. The business this year is trading on a near 7% free cash flow yield when adjusted for its excess cash. Another software business here and another large investment in the portfolio is ReadyTech. This is also a sticky software business around payroll, education, government, and judicial sectors. 80% of this business is subscription revenue. And that's driven by a combination of price increases, where inflation has actually been beneficial to the business, selling more software to existing customers, and attracting new customers. That organic growth has been at approximately 15% over the last couple of years, and it has been bolstered by some attractive acquisitions of other businesses. We think this will continue for the long term, and importantly, we think that the higher capital expenditures that the business has undertaken over the last couple of years will reduce as a percentage of revenue over the next couple of years, really improving that cash operating leverage. Now, while the business trades on about a 19 times price earnings ratio this year, that number is due to fall quite substantially into the next couple of years as earnings grow.
And now moving on to Integral Diagnostics. As you may be familiar, this is a chain of 90 radiology clinics across Australia, but mostly in regional Victoria and southeast Queensland. The long-term context that you need to keep in mind is this is an industry that has been growing revenues at 6 to 7% on average for the last 20 years. Now, the opportunity now comes from an unexpected drop in activity during the pandemic at a time where cost pressures are quite acute. Our view here is that volumes will normalize and then that margins will reset gradually. On volumes, we're already seeing good evidence of a strong activity as hospitals deal with the backlog of postponed surgeries and neglected disease burden. On margins, there is some gradual progress in terms of relief from higher indexation of Medicare items. We're already getting more traffic through the top of the P&L, more patients going to the clinics, and we're yet to see a normalization of the wage and rent bill. Finally, in terms of mergers and acquisitions, they can also act as a kicker to returns in our investment here, as IDX continues to use its balance sheet to acquire smaller clinics, or in case they find themselves the subject of a takeover approach. And now moving on to the macro backdrop into next year. If you notice a defensive tilt in our portfolio into this fiscal year, here's why in a couple of charts. At the current level of interest rates, the share of average income destined to pay a mortgage is at all-time highs of nearly 40%, as you can see on the chart on the left. That means that for those of us with a mortgage, which is 1/3 of the population, we are experiencing a substantial erosion in our disposable income. So if you're on a variable rate, you're probably feeling the pain now after 12 successive hikes from the RBA. And if you're on a fixed rate, the pain is about to come, and the chart on the right shows you when the pain hits home. You can see that between the quarters of June to December, nearly 50% of the mortgages, the fixed mortgages, come up for refinancing. And so it doesn't matter whether you're fixed and variable, the important point is this is a substantial amount of money that will have to be redirected away from other uses and into paying the bank, and that's clearly negative for consumption. And that's a good introduction for this slide. It's not a coincidence then that if you look at consumer discretionary stocks, which represent around a quarter of the market, they look like our basket of discretionary retailers on this page. And that you can see that they're around 50% down from the cycle peak in 2021. Just think about all the people that bought a house in 2021. If you did, you probably bought a couple of loungers from Nick Scali, and you're unlikely to buy another sofa in the next 5 to 10 years. That clearly doesn't bode well for future demand. Now, this is a sector that has been a train wreck in slow motion for the last couple of years. We at Forager intentionally decided to stay away from it as we saw the juxtaposition of high sales in the lockdown with slowing momentum rolling forward. So you could call that the inevitability of the business cycle, and we would agree with you. But anyway, hopefully what this means is a good setup for opportunities into this coming year.
And on opportunities for the 2024 year, one of the areas we're looking at intently is beaten down smaller and micro cap stocks. Now, over the last 3 years, we've seen a 28% cumulative underperformance of smaller industrial stocks to the overall larger cap indices. Now, there have been many reasons for this. Attention's dissipated from the space, money has flown out of funds, and liquidity has worsened from already low levels. This is a vicious cycle. And it's left some of these smaller businesses trading at particularly attractive valuations.
So maybe some sectors are worth calling out and for you to keep in mind. That we talked about consumer discretionary stocks earlier. To give you some context, the basket of 10 discretionary retailers that we showed you before have declined around 50% in terms of share prices over the last couple of years, and that corresponds to a 15 to 20% earnings cuts, and the balance 30-35% corresponds to multiple compression, and hopefully that set up for some interesting opportunities in this coming year. The other one worth calling out is non-bank financials. Over the last couple of years of easy money, you might have seen these non-bank lenders making loans left, right, and center, and booking profits based on estimates of bad debt. It's only when the tide rolls out that we get to see who's been running a viable business and who isn't. Maybe another one to call out is fund managers. We only know too well from our own experience that these businesses are highly geared to equity markets. When equity markets reset lower, there is a potential for a vicious cycle of lower inflows, lower fees, operating leverage working backwards, and maybe even negative valuations on top of that, pretty much in the same way that retailers have done. These are just some of the opportunities that we're focusing on into the new year. And with that, I'll turn it back to Steve.
Thanks for that, gents. I'll just wrap up the Australian Shares Fund section by talking about the traded price of the FOR units. Back in 2021, we took a number of steps here to try and mitigate the discount that the units were trading at on market relative to the fund's underlying NTA. We instituted a distribution policy that I've touched on earlier, where we target a 4% yield for this fund. We've been undertaking a buyback over the past few years. In fact, we've bought back more than 10% of the outstanding units in the fund over that period of time at a discount to net asset value. And we've been working really hard on improving the fund performance, which, as you've seen today, has been showing some really positive signs. As you can see on the chart, the discount that the units were trading at had narrowed quite a bit as those actions had taken place over the past few years. But as we sit here today, the discount is back where it was prior to us implementing all of those changes. This is a very hot issue at the Forager board and amongst the team. It is not something that we view as long-term acceptable, that the units trade at a huge discount to NTA, and we are constantly considering what other actions we can take. So that's a wrap of the two funds. I hope it's given you a good insight into what's happened over 2023. Some really exciting businesses that we own, not just for 2024, but companies that I think can grow and prosper over the next 5 and 10 years that are today trading at really interesting prices. I touched earlier about farming. I'm very scarred by growing up on a farm because the difference between farming and the share market is that the long-term average is very, very mediocre returns on your capital. Yes, there are violent swings, but it's important to remember when it comes to the share market, those really long-term 100-year returns that we've seen of 8 to 9% per annum from equities add up to really meaningful returns over time. You can see in this chart on the left-hand side how investors in both of our funds at inception have grown their investment by about 3 times since their initial investment. That's 2009 for the Australian fund and 2013 for the international fund. I think we're really, really well placed to build on that track record at the moment. We made some really important adjustments to the way we do things back in 2019. The portfolios are more liquid today. There is a better balance of different types of stocks, and I think some better quality businesses in there that are going to be really important to future returns. You've seen that start to turn up in some much better returns in recent years. We've been able to deliver strong performance throughout 2023, despite further small cap underperformance. At some point, that trend is going to reverse and it's going to become a tailwind for fund returns. The returns throughout 2023 have come from some traditional Forager sweet spots. Lots of stocks taken over in both portfolios, lots of really attractive prices in small cap land. As I said, I think that small cap underperformance will reverse at some point in time, but it's actually a really prospective market for us as well. I want stocks to remain cheap, and a higher interest rate environment where people are pricing stocks more appropriately is better for our style of investing and our ability to deliver outperformance. And finally, both funds have fairly substantial performance fee deficits in them, meaning that today's investor is not going to be paying performance fees until there has been a substantial amount of outperformance in future. We think the setup is really nice. We think small caps deserve a larger weighting in a lot of people's portfolios than they have at the moment. We think both funds are set well to perform over the coming 5-year period. Thanks a lot for tuning in, and we will turn now to Q&A. Welcome back. We've already got some questions in the queue, so we'll get started while you keep entering your questions in there, and only enough space on the stage for the three of us. So I've got Alex Chevalev and Gareth Brown here with me to answer your questions. I will deal with the first one. I've had quite a few questions here about the publicly traded FOR vehicle and the discount to NTA that's trading at. I'll maybe read one of those questions, I think, as a good example that sums them all up. In hindsight, do you think it was the right decision to list the Australian Shares Fund? The main benefit of listing was to improve underlying performance by not having to sell at inappropriate times if investors withdrew money. However, it looks like performance after listing in NTA terms is worse than prior to listing. Not having a dig, I love the fund and have been an investor since inception. Just interested in your thoughts. Look, as I said at the end of the webinar, we are actively considering all available options for the fund. But that question raised an interesting one for me around whether we regret doing it at all. I think we learnt some very difficult performance-related lessons about liquidity in the early period of the fund being listed, and I do think it was a positive thing that it was a closed-ended vehicle at that point in time. But we run a more liquid portfolio today, and we said at the time that we listed it that it trading at a massive discount to NTA for extended periods of time was not an acceptable state of affairs. We said that again last year, and given what's happened over the past 4 or 5 months, and I think to the wider sector as well, it is an issue that is high on the agenda here in terms of what we do about it. So I think 2 answers to that question. I don't regret it, but I think we can manage, and we've learnt a lot about liquidity in the portfolio, and we are considering what the future of that fund looks like all of the time, but particularly at the moment. I'll come to you, Gareth. A question here from Dan. What's your highest conviction global stock on a 5-year outlook?
I've got a few. They're the largest positions in the fund, you won't be surprised to hear, and they are stocks that we have covered in this presentation. Ferguson's one that both Harvey and I are emphatically in agreement on. This is a distribution business, so connecting tens of thousands of suppliers with millions of customers. It's a really nice place to be, and it's very hard to dislodge someone like that. Yes, it's cyclical, but it's also a structural grower. And we think it's one of those businesses that can get stronger in difficult times. So you can get an edge over competitors, both through organic investment and through M&A in more difficult periods. And lastly, we think we've identified reasons why the stock is being too cheap, and it is currently being rectified. This is now predominantly, the main listing is in the US. It will be included in the S&P 500 at some point. It will find a new group of shareholders to pay attention to it. So we like that business a lot. And the other one on the top of my list in particular is Blanco, which is currently the largest holding in the fund. It is a business that has grown nicely. We think it can grow even more quickly. It's just in a really nice place there with two really strong tailwinds, both data security and environmental. And in particular, we not just selling the stock to investors, but we think it's very interesting pitch to clients. How can I help a client improve their data security? How can I help them improve their environmental footprint? They're things that are blowing strongly and only increasing in strength. And lastly, we touched on it here. We think there's some pricing power there that's been largely ignored by management and the market that is increasingly coming into vision for people.
Yeah, a couple of, I think, high quality examples there. I'll just add a couple from the CIO's chair when I sit there and look at the portfolio, and they're smaller weightings because they come with more risk, but we think both Janus and Taskus, I'm still a value tragic at heart, and they're beaten up share prices that I think the potential for those businesses is quite significant, and the potential for a perception change over the next 5 years as well in terms of reflecting that value. Just really quickly, we own a couple of UK stalwarts in the portfolio, Tesco, Lloyds. A lot of worry about that economy in particular, and also the market over there. Where's the UK in 5 years' time?
Yeah, so firstly, we've bought these things on prices that we think, even if the environment stays tough for an extended period of time, these are mostly very resilient businesses and cheap share prices to begin with. We think the business alone can give us very reasonable returns over the long term. And then at some point, the UK will find a way not to stay the basket case of the developed world indefinitely. At some point, people will notice these stocks, and we won't just get the business returns, but we will get the multiple uplift as the stocks start trading more in line with their global peers. That's the thesis, and we think that plays out over 5 years. I don't think it's a 10 or 15 year story.
I was about to say whether that happens within 5 years or not's a different question, but they've done their best to make a mess of things over there. But it actually does seem, I think, both politically and economically, like there's finally some sensible people around the table.
I just add to that, 5 years from now, it's still the basket case. If we haven't got low teens type returns from these stocks still, I'll be very disappointed.
Alex, I'll come to you. There's a question here relates to both funds, maybe relates a little bit to that question as well. We always put stocks up in the presentation, highest conviction ideas, and get asked it. But an anonymous question here says, to what extent does the team feel that some of the poor outcomes from stocks comes from poor analysis or estimation of future cash flows? Or is it a case that a lot of the small companies have poor management or make stupid decisions? I'm a long-term investor and find some of the stocks that the team gets most excited about end up the worst the following year.
So we run a portfolio of about 30 stocks on the Australian side, and some of them we highlight in certain presentations, some of the larger ones we highlight. I mean, THL from last year is not a bad example. We've spoken about it continuously. We talked a lot about some of the technology stocks as well. Gentrack, a significant contributor this year as well. And for some of the smaller businesses that have dragged on performance, some of it has been, as that questioner asks, the misestimation of some of the cash flows. Some of it has been a pretty dire environment for small and micro cap stocks. We put up that slide of 28% underperformance. that's really dragged down the valuation multiples of businesses that are even delivering to our expectations in that space.
Yeah, I do think it is a space where management matters more as well, that the decisions actually drive the outcomes. A lot of the large oligopolies here in Australia, sometimes the management's made out to be heroes, sometimes they're the devil, but in my view, and I've said this a lot on Qantas over the past couple of years, the structural positions of those businesses are far more important than the person running it, whereas in small cap land, it does make more of a difference. I've actually found that bull markets are really, really dangerous for management decisions. We've certainly had that in the international portfolio. A number of big, stupidly priced acquisitions that ended up being quite disastrous in the portfolio. And I'd say almost every single one of those stocks that we talked about in the performance report, as we moved on from them because they weren't delivering, were related to acquisitions. So it is important in the space. Look, I think the other thing for people to think about is we do run a portfolio here. We've got almost 40 stocks in the international portfolio, 30 in the Australian fund. Our conviction levels can change over the course of a year, and we really have worked hard on trying to upsize the right investments and exit the ones that aren't working as well. So it is a space where things go very, very right and very wrong, and it's important we get those weightings right as well. Chev, quick one. How much in percentage terms did the sale of Qantas and Seven contribute last financial year, please?
So together they contributed last financial year, FY23, about 3% combined.
Yeah, that's all in your performance report as well. So download the performance report. There's quite a bit of detail in there about those stocks and similar sorts of weightings and similar sorts of share price appreciation. So something like 1.5% of contribution from both of them on 40 and 50% share price gains. Gareth, can you clarify how the performance fee high watermark works? How can investors calculate it?
So we have underperformed since we last received a performance fee. So we have a lot of catch up to do before we have to worry about a performance fee. But it's, you're probably best to explain this. We need to outperform the index to effectively accrue a performance fee, but we have a lot of, I can't remember.
I'm calling it a performance fee deficit. I think that's a nice word for it,
exactly.
that we have effectively a negative performance fee that we need to earn back before performance fees are paid. In the international fund, that's currently more than 10 million, which to translate it back to percentage, it's a dollar amount. To translate that back to percentage terms, the fund would need to outperform by more than 40% at its current fund size. Again, it is dependent, it's a dollar amount, so if the fund were to grow or to shrink, that percentage can change. But that's the best way to think about it, is that in that international fund in particular, there is a huge amount of outperformance that would need to happen before any performance fees are paid. In the Australian fund, Alex, the fee structure works the same way. It's a dollar amount carried forward. It is less in terms of the underperformance over the past few years, but there's still, I think, a bit more than $5 million of performance fee deficit there that needs to be earned back before people are paying performance fees in both funds, and it's a really important thing for people to be aware of as today's investor.
The difference being that the Aussie fund is an absolute return hurdle and the international fund is versus an index.
Alex, a couple of the tech stocks here, I'll ask them quickly. In Whisper's latest quarterly result, they lost a lot less money. It's directionally the right direction. Can you speak to your outlook on Whisper's future growth profile, and comparison to competitors?
As you can see from the performance report, it's been a poor performer the last 12 months. We feel that there's been some bigger decisions made there in the business in terms of controlling the cost base there. So yes, smaller losses are positive in this case. The company in that same announcement made a comment about FY24 perhaps not needing to draw down the debt facility they established most recently to give them the support that they potentially would need. So that bodes better for the FY24 year. And we hope that actually translates to a cost base that can stay similar to current levels, but revenue that actually grows and that gap starts to open up.
Yeah, it was for the first time in some time, an encouraging quarterly update, I would say, particularly on the cost side, but also some signs of stabilisation of the revenue there. Our other little problem child, I guess, over the past 12 months in that space, Big Tin Can. There's a question here about our views on how they reacted to supposed bids for the company?
Yeah, I mean, that was an interesting reaction. I mean, the bid undervalued the business, but then the thing that has been questioned by many investors, the subsequent raise of capital that went into various acquisitions. Part of that potentially offensive to improve their standing and their ability to deliver revenue growth in future. Part of that is defensive, where perhaps they were falling slightly behind where they needed to be in their own spend.
Gareth, after listening to your podcast before Christmas, it wasn't you on the podcast, it was Harvey and I, but you discussed Yeti products. Since you mentioned, I see the products everywhere. How are the kids' drink bottles holding up? Do we still own the stock? And I am a complete convert.
So that's 3 from 3 on the drink bottles holding up. That's now 7 months, which has got to be some sort of record, because we would buy things that were typically 70% as expensive as the Yeti, and they'd be chewed up and ruined within a few months. So we haven't even lost one either, which is also impressive.
For people that aren't familiar with this business, drink bottles is a big part of it. Kids' drink bottles, presumably not so much, but it is an outdoor equipment originally renowned for their large
Coolers, yeah.
We would call them eskies, but cooler boxes in the rest of the world.
Very fancy ones.
Yeah.
Well, this is a very product-driven company, but it's also a consumer stock, right? So it has become an increasingly difficult environment for this kind of consumption in the US. We got this stock cheaper than we would have otherwise if it wasn't for some concerns around the environment, the economy. Sorry. So, that's part of the reason we now own this stock. It's trading fine through this, I think. A few question marks on the product side. We had an issue with one of the cooler bags. They had an issue with their magnets, so they took them all from the market, which is the right thing to do. They've been pretty slow in bringing that back out. Again, I think the right kind of product company, they take their time on things like this. So it's not necessarily a bad thing, but I guess it's a bit of a surprise that it's taken a while to get some of these products back on the market.
Yeah, I'd say in both funds, this consumer discretionary space is becoming increasingly interesting. There's been a lot of negative price movements over the past 12 months. Alex touched on it in the main part of the presentation, but it's a sector here in Australia that's been under a lot of pressure and hopefully some opportunities as well.
Yeah, I think that's right. And we have been going into this period of somewhat discretionary difficulties with less of that weighting than you would have perhaps otherwise expected. You saw some of the macro slides that were put up there. That's really left us somewhat cautious. But now some of those valuations have reset in the retailers, in the more economically sensitive businesses, even some exposed to general investing confidence as well, whether fund managers, platforms or what have you. So a lot of interesting places to hunt because of that negative perception.
Yeah, and in both funds, a little toe in the water there. And I think Yeti's a good example of, if we can buy that stock another 30 or 40% down from here, then it's going to be a meaningful portfolio waiting for us. It's already meaningful, but I think at the moment this is a really interesting business. We think it can grow long term. It's at a perfectly reasonable price because of the pullback. That doesn't mean in a horrible environment it can't get lower than where it is today, and accordingly the portfolio weightings reflect that. Question from John. I think the Australian fund style changed around 2019. So is it still small cap value fund or more a quality fund?
I think you have to think about value in a couple of different dimensions. One of those is how quickly that business will actually grow its free cash flow per share over time as well. And the other bit is how certain are you of actually getting it, which suggests a look at the quality and whether those outcomes are going to be really widely dispersed or somewhat closer together. You have seen some more quality businesses in that, especially larger weightings that you've seen. RPM Global is one good example. Gentrack, that's delivered quite well for us, another this year. And those businesses generally are supported by some businesses that are perhaps not as sticky in their revenue, but trading at dramatically lower valuations a little bit further down the portfolio list.
Yeah, I mean, we own mining services stocks, for example, that's 5.5%, 6% of the portfolio at the moment that are 4 times earnings and actually showing reasonable returns on equity at the moment, but historically has been a troubled sector. So you should definitely expect to still see value stocks in this portfolio. The big lesson for me from 2019 was at the right time and in the right portfolio construction way, rather than we need to be extremely deep value all of the time, all the way through the cycle. And you can be contrarian and value driven when good quality companies and companies that we think can grow are under a lot of pressure, and we've seen quite a bit of that over the past 2 years. What I would like to see in our future is that you see a lot of flex in these portfolios, that across a 5-year period you see us have substantial amounts of the portfolio in different types of stocks, because those stocks are unloved for reasons that we understand at that point in time. And that might be a bit different from the blind I think value focus of, I would really say 2016 to 2019, because in the early years of this fund, we owned Macquarie Airports, we owned Spark Infrastructure, we owned ARB, we owned a number of businesses that did well for us. As those companies got, I would say, expensive, it was a mistake for me to think, well, I need to be only buying cheap stocks. What we needed to be was more patient there. And there's another question here on that, Alex, about the cash weighting. Is it high because we think there's going to be great opportunities to deploy it, or what is the reason for it?
So at the moment, the cash that you see at the end of June has actually been drawn down somewhat by a couple of opportunities that we've invested in over the last couple of weeks. Broadly, we are waiting on some of the sectors that are a little bit more cyclical. We've done quite a bit of work there, but are waiting for perhaps more opportune prices. On the flip side, there are some larger stocks that we have had in the portfolio over the last couple of years that have now reached their maturity, and as they've reached their maturity, we've converted them over to cash, and for liquidity and the diversity of the portfolio, we're sort of looking at other opportunities in that space and not seeing quite as many on the large cap side.
Yeah, I think that's a really good summary of it. And in this market at the moment, with large cap valuations where they are, I would rather a portfolio that's 20% cash and 80% really cheap small caps than be diluting that capacity, or paying higher prices for the large cap end of the portfolio. And we've already, I think Gaston touched on it in the presentation, but the cash weighting today is about 13% after the distribution went out, and also after a couple of portfolio additions over the past couple of weeks. So it doesn't take much for that 20 to become 10 in pretty short order. We need to wrap up here. We're running out of time, so I'll answer a couple of really quick questions. The 4% dividend yield for the Aussie fund based on share price or NTA, that distribution is based on NTA, not share price, and it will be the same distribution this year as last year. So you can expect that to be roughly the same. I just want to reiterate one more time, I say it repeatedly, but the returns in this fund come from capital gains, and the distributions are a way of us paying some cash out of this vehicle for people who want it, but long-term returns are completely contingent on capital gains, and you should make sure that you treat the investment as part of the growth/capital gain part of your portfolio, not as a income yielding investment. And there's a good Taskers question there. Harvey sent me a good answer here, but I will send that to you privately. So that will wrap us up for today. Look, one last point from me on the Australian fund vehicle. We'd really love to get people's thoughts on it. So if you have a preference, or there's a point of view that you'd like to get across, please send us an email. We'll take that into account as we are exploring what we do on that fund. If you've asked a question and we haven't got back to you, we will do so. And we will be posting the slides here online and emailing them out to you for people who want to go back through today's presentation. Thank you for tuning in once again, and we'll catch up soon.